it is my pleasure to officially welcome each and every one of you on this Zoom to this important conversation with Charlotte Kettler, co-founder and CEO of Capwave.ai, about the topic that is always top of mind for all of us, for many of us at the Fourth Effect: how to access funding and what investors really want, and how to tell that story while also successfully scaling and building your company. Founders, we often believe that we know what investors want, but the reality can be quite different. I think many of us have probably had this experience. You set out to fundraise, you feel really great. You sit down and have these conversations, you might be left with your head spinning. I'm really looking forward to hearing in this webinar all about key elements that can make a company truly investable. Understanding what investors actually need to hear versus the common founder misconceptions. Very curious about that, how to speak investor effectively. Charlotte is going to help us learn how to craft a pitch that resonates with investors, align our businesses with their expectations, and ultimately increase our chances of securing funding, which is what we all need. So before we dive in and I hand the floor over to Charlotte, just a very brief word about the Fourth Effect. For those of you that are not already premium members inside our platform, either as a startup founder with a connected startup account, or as an executive member who wants to maybe be an advisor or be a director for those startups, possibly an investor to those startups, a mentor, an expert service provider. Those are kind of the two general sides of our marketplace. Sometimes people wear all those hats. If you are not already inside doing those things, we really, really encourage you to start your free trial today. So we will share a link in the chat that will take you on our website. It's very easy to, kind of choose your own adventure. What is the path that most applies to you? We'll direct you to the right membership. You can get started right away, having full access to the platform for 30 days. We hope you'll stay with us forever after that. But there's no reason not to dig in and just really figure out what we've built and how it can help you as a founder build out your advisory boards, governing boards, and fundraise more effectively. Find those mentors, expert service providers, talent, all the things you need to really be healthy and effective and scale. And then on the other side, as an executive, we want to help you initiate and advance your for-profit board career by serving as an advisory board member, maybe an independent director, a fiduciary board member. We want to help you start investing if you're an accredited investor, and also mentor and just really develop professionally with the network that we have. So if you're not doing this, come inside and do it. We do platform tours all the time where we really help you understand, see it in live actions. You can always sign up. We'll share that link too. And then once you're inside the platform, please, 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 every Friday from 12 p.m. to 1 p.m., we have office hours, and that's Kat, myself, our head of product. We're all there to help you to make sure that you get what you're looking for by joining us. So I think those are all the things I had to say. I think we also have a board bootcamp coming up soon, so we'll share a link to that and a code. But then otherwise, I will stop. Let's get to the point of today. We could not be more excited to introduce Charlotte. So Charlotte, the stage is yours.
Thank you so much. To everybody here that's a founder and also executives, please join the Fourth Effect. I think it's super important. And you will see in this presentation that network is one of the most important things for getting funded. So get started and listen to Breen and Kat. You will definitely not regret it. With that, from founder to funded, I would love to get started first on kind of seeing who is in the room to make sure that we will cover everything that you need. And just making sure that we have everybody here. So who is in a room that is a founder? And if you have your camera on, can you just raise your hand or otherwise virtually do that? Awesome. Okay. So with that, founders, this is obviously for you to make sure that you know exactly how to raise capital. This is going to be all about raising capital. We've raised 400 million for our clients and are now helping you and giving you all the tips and tricks. Then I'm quickly going to skip to, are there any service providers in the room? because we need you as well, actually. All right. And then, of course, we might have some ecosystem. I'm always putting this in here because if you don't know your ecosystem builder in your city yet, go find out who it is, because those people actually put a lot of events usually on. And on top of that, they are actually incentivized to help founders like yourself. So they will do a lot of intros. And then, of course, investors. All right, so today we're really going to talk about what an investor really wants to hear. We'll start with the investor mindset, common founder misconceptions, key elements of an investable company, crafting a winning pitch, and tools, resources, next steps, and Q&A. Just a very short background on myself. I started as an investment banker in New York City now 12 years ago. And I started my company Van Net, which is a boutique investment bank where we raise Series A and Series B for founders now 4 years ago. And I am currently a startup CEO, the CEO of Van Net, an advisor, mentor, and investor myself. I love putting checks into new companies. So if you have something interesting, you can always send it my way. And with that, we're first going to start looking at what investors actually do and how it works for them, because I think it's super important that you have an idea of like, how do they look at deals and why do they either say no or say yes? And yeah, really take a look into their mind. So first of all, for a lot of the investors outside of angel investors, but a lot of the VCs especially, they first need to do fundraising themselves. They raise funds from LPs that can be high net worth individuals or pension funds, endowments, and such. And once they start fundraising, they usually have their first target between $25 and $50 million for an emerging manager, and then it goes up over the hundreds of millions. But the last couple of, I would say, 8 months, 9 months, 12 months has been very difficult for investors themselves to raise capital as well. And that's where the chicken and egg problem kind of comes from, where you see, hey, okay, investors cannot raise capital, so they cannot raise their funds, and therefore they cannot deploy capital. So here, I kind of want to just make sure that you understand how this all works, especially when you're pitching a VC. They raise funds from LPs, then they invest in companies like yourself. Then there's a harvest phase where they hope that their portfolio companies grow and grow and grow. And that's then eventually when there are exits happening. And then they distribute the cash back to their LPs. What is important to know about this is that investors look for high growth companies, especially institutional investors. So if you're targeting those, you need to have a market size of at least $1 billion to actually make sense for them to invest in you. If you are not at that stage or you don't see that massive market for yourself right now, and by the way, that can be global as well, but if you don't see that massive market for yourself, then there is a different type of investor that you should go after, and those are more of like the angels and potentially even some debt providers that could have a great impact on your business. So we can talk about that if you have any questions about that. But just so you know, investors, especially institutional investors, they invest in a couple of startups per fund and then hope that these startups grow as big as possible and then get exits so they can return cash to their LPs. LPs expect 20 to 30% IRR. And because startups, as we all know, startups do fail. So investors hope to at least have 1 or 2 home runs in their funds to kind of return the whole fund. The reason why this is important to know is because you want to align your pitch to the investor expectations. What do they invest in? What's their secret sauce? And what if they kind of like promise their LPs? And with that, let's go into how investors really look at businesses. There is this threesome of risk, scalability, and returns. So when you pitch your business, you need to touch upon all these different areas. And the main 3 questions to answer for your own business is this a problem worth solving? Are you the right team? So do you have a secret sauce? Like, why are you actually building this business? And then on top of it, of course, the market demands. But the bigger the market, a lot of investors love a big, big market because then you should be able to win and scale. And then let's go over some of the misconceptions. Of course, as founders, we have more of a rosy lens on how quick we will find product market fit, because usually we start businesses because we have experienced this problem ourselves and we would use it immediately. Now, an investor, when you look at a product market fit timeline, they really currently look at 18 to 24 months. So just keep that in mind when you talk about your business. And if you still think, hey, we can do it really quickly, then back that up with data. That is super important. In the end, early traction is key when you raise capital. So for example, when you are just still building and you're in a pre-seed phase, show how much interest you have, maybe start a paid wait list or anything like that to kind of show, hey, there is actually market demand for this. Then when we look at go-to-market strategy, I was actually just chatting to Kat that TikTok is a big platform right now, especially for a lot of newer founders. And it's all cool and TikTok is cool. And yes, you might be able to go viral, but that cannot be your strategy. Your strategy needs to be super specific with exactly the right channels. And when you talk to investors, it's important that you actually know what you're talking about and how actually you're going to win this market. Then valuation metrics. A lot of founders still think that valuation is really based on the projected future revenue. And of course, that plays a factor. But at the moment, in the current market, it is super important to focus on the current traction and comparable benchmarks. So see where your competitors are at and how much have they raised in the current market, so the most recent deals. And then when it comes to burn rate and runway, it used to be that a higher burn rate is acceptable for faster growth. Unfortunately, not anymore. We're really focusing on sustainable growth at the moment as investors. So show that you have clear unit economics, you know exactly how you're going to bring your cost down, and show that you can have 18 to 24 months of runway with the amount of money you're raising currently. So really demonstrate that you have grounded projections and a compelling big vision, and make sure that you have this all to back up what you're actually displaying and demonstrating as like, this is what I'm going to build. So then investable companies, they all share a blueprint, and there are 4 pillars. Number 1 is every investable company has a great problem solution fit. So there's a clear problem to solve. It's a problem worth solving, and you have the superior solution. And what I wrote here is differentiate, differentiate, differentiate. And that is because you need to know the market, you need to know your competitors, and you need to know why you are going to have the winning product. It does not mean that if you have competition that you can actually not be successful. You can be successful, but you need to know exactly how you're different and why people would choose your platform over somebody else. Market opportunity, make sure that it's a big market so you can scale even if you only have a small piece of the market. And then traction and metrics really show market validation. So what I mentioned earlier about this paid wait list, that is important. It is important that you show not just, hey, we have a wait list because it was free to sign up and everybody just signed up, but actually a paid wait list shows that, hey, actually people are interested. Same as like, what is your conversion from a free trial then to a paid product? And then what's your retention? All of this data is super important. And then team and vision. What is your secret sauce? So why are you building this and not anybody else? And why do you think you will be the person winning the market share? A compelling pitch is more than slides. In the end, winning an investment or getting an investment from an investor is all about storytelling. So you need to have your narrative right. Investors get thousands of pitches. So it's important that your pitch is short, your pitch deck is short, and that it's super clear what you're actually doing. So try to focus on the high impact messages that you can send to an investor to just get that first meeting. That's the most important part, especially for your pitch deck, for the pitch deck that you're sharing with others. So first of all, we always say, let's start with a company purpose. Why are you actually building this? Of course, problem and solution. That's very normal. A lot of founders forget the why now slide. why is right now the moment to build this company? And if you think about this, I just want to give you an example. When Uber and Lyft came online, the only reason why they were able to do it is because at that moment we had smartphones with location. That's a way for taxi drivers to find us, and that's a way for taxi drivers to use technology to have their business running. So that was one of the reasons why Uber and Lyft at that moment were able to win in that market. But if they had done it 20 years earlier, that was probably not possible. So think about that for your own business. Why now is the right moment to build this? Market size, we already talked about. Competition, really know your competition, know exactly how you're winning compared to them, or how you're different. Of course, your product, if you can put in a demo link, so record a Loom of a demo of your platform. So if an investor wants to look at that before they have a meeting with you, they can. And then business model, be super clear, not only about your pricing, but also about your sales and go-to-market strategy. Team, again, your secret sauce. And then financials. Always have some sort of projections that gives a clear ROI for the investor. Of course, your use of funds, why are you raising the amount that you're currently raising? And then if you have raised before, make sure to include a cap table. You don't have to put this all in your teaser, but just make sure that you have it in your data room when you share that later on. Then align your story with the investor priorities. Investors care about clarity, data to back it up, and thesis alignment. The thesis alignment, number 3, is important because an investor, when they go out to market to fundraise for their fund, they say to LPs, we are amazing at finding companies that do fintech. We've done a lot of payments companies, and this is how we've grown them. And that's where we have a competitive advantage. So if you, as, for example, an HR tech company, go to a fintech investor, there's no thesis alignment and they will not be able to invest in you. So it's super important that you do your research, and we'll go over that later on, but do your research and make sure that you exactly know why you are the right portfolio company for that investor. Here are a couple of examples and how you can really make sure that you hit that on the nail. So make sure that you are super clear in what is the problem you're actually solving, and how are you solving it? How is your data? So what kind of traction have you had over the last couple of months? And again, if you're new, it can still be like a paid wait list, or it can be we have grown our LinkedIn or newsletter subscribers by X. Like, it's just important to show some sort of traction. And then again, that thesis alignment. In the end, thesis alignment should be important for yourself as well, because you want to take smart money over just money. And it's important that the investors that you choose actually have or can help you in a way by either giving you introductions to customers, or helping you with some sort of marketing or sales or anything like that. Just make sure that you know it's not dumb money, as we say. All right. Then metrics. So what are the metrics actually that are important to show? Since investors are finance people, they love looking at metrics. So think about this and make sure that you know what kind of metrics they're going to expect. We have a resource on this, which we can share later on, but the most important thing is that you show the metrics that are important for your business. So for a marketplace, that is like Airbnb or Instacart, that's different than for a social app, a subscription business, or e-commerce. So take a look at this. We will share the slides later on so you can see, hey, this is actually where my business fits and how I should portray this. The most important part about this is that you don't just show a moment in time. No, you show a period of time. So you always show a full graph of like, hey, this is how it has been going over the last week, a couple of weeks or months, depending on how old your startup is. And then again, make sure that it's $1 billion market when you go to an institutional investor, or otherwise have an idea of how you're going to expand it to a massive market. Just know your market, know how you're going to grow it big. And then funded founders have 2 pitch decks. Not a lot of people notice, but for your teaser, that's something different than the pitch when you're actually talking to an investor. You're not doing the same slides. Why is this important? Your teaser should have all the information to create this, hey, I want to talk to this founder. This looks amazing. And this could potentially be a great investment. It should just be short, 10 slides designed to grab attention and to really get that first meeting. So still minimal text, but it should be readable. Focus on those clear metrics and your message. What you can do, what I always really like in your teaser is like every header should be part of your narrative and your story and why this is such a great investment. Then for your pitch, you're not going to put a lot of text on there. It's just going to be photos, metrics, just to kind of like enhance your storytelling while you're talking about your business. Of course, all your metrics should be there, your projections and stuff, and all of that information should be there, but make it super easy. It's not meant to be super like readable. It's just part of your storytelling. And then this one is super important. You need to know your stage because investors look at businesses from a stage perspective. Of course, we know the rounds, but like, what do you need to do per stage, right? So when you're pre-seed, you're still in the discovery experiment stage, which means that if you're raising pre-seed, you can actually just come to them with the traction of a paid wait list, or we have grown our following so far, and this is what we have so far with our beta. These are all the beta questionnaires that we have done, the interviews that we have done, etc. So during pre-seed, that's totally fine, and you don't need to have like a lot of ARR or anything like that. When it comes to seed, we want to see a little bit more of like, hey, can you prove that your customers stay on? How is your retention? How have you been growing? Like, are people interested in this? And what are you doing about making people happy with your product? And then for Series A, you really need to show that this is super scalable. And for Series B, you need to start expanding. So then kind of like your Series A, where your first product is super scalable, you are scaling it and it's now a sort of an automatic scale. And then with Series B, you need to show, okay, we're expanding into this other category that is adjacent, but then will bring us another $50 million or something like that. So just think about that. Think about where you are and what the expectations will be from this investor. Oh, by the way, real quick, if you don't know exactly, just make sure that you are always in the know about all the investment market data. Go to Carta. That's why I put those here. Carta brings out quarterly reports and yearly reports where you can read a lot about the different stages. You can know about your dilution that you should expect, the type of valuations that we're seeing, and they even have some industry data as well. So take a look there. And then how do you run the process? Because that is the most important part, right? Well, first of all, you need to do a lot of research into who would be the right investors for us. So one is build your investor funnel. You need to have at least 200 qualified investors. Qualified in this case means, are they investing in your stage, in your industry, in your geography? Are they currently still investing? So start with at least 200 and then know that you will get 95% no's and that is normal. So don't get discouraged when you get a no. If you haven't talked to 100 investors yet, you cannot expect a lot of commitments yet. Then filter again after your funnel, because then you want to see, hey, have they invested in any competitors? Because they will definitely not invest in you, and they will just use a meeting with you as, oh, I want to know what they're doing, and then I can tell my portfolio company how to do that as well. So be careful with that. Be very careful. No, if they have no dry powder. So a lot of the VCs right now, especially the more emerging ones, do not have dry powder to deploy. You can know that from what was their latest fund and how many investments have they done. That's kind of like how you can see, hey, do they still have cash to deploy? Yes or no. Have they done recent deals? And of course, bad reputation. This is a hard one. I think it's important that you kind of see, hey, what's in their portfolio? Then look on LinkedIn, see if you know any of these founders or if anybody of your network knows these founders that are working with these investors, and then see if you can grab a coffee with them or a virtual coffee or anything like that, and ask questions. Doing or like going into an investment deal with an investor is like a marriage, and it's super, super, super important that you exactly know who you're going to deal with. So do your research as well. It's both ways. Um, and then you map your target list with your network. So anybody in your network who is connected to your target investors. Basically, what you do is you go through your 200 or 150 investors, and then you go on LinkedIn and you figure out, hey, do I have anybody connected to any of these investors? That's a great way to then start asking for intros. So then you send a list of like, hey, Kat, I see you're connected to 5 of the investors that are on my target list. Would you be willing to give me an intro? Or, hey, Breen, I see that you know actually 20 of my investors that I would like to talk to. Can you please intro me? Be super specific on this, because if you just come to me and say, hey, I think that these investors would be great for me, can you please intro me? I still need to know, why do you think these would be great for you? So be super, super clear on why you want that intro and why you think this would be great for you, and for them, of course. Then get organized, use a CRM. So, in the beginning, you think, oh, I'm talking to 10 investors, it's fine. I know exactly what's going on. But since you need to talk to at least 100, make sure that you have some sort of CRM. You can do it in a Google Doc or in a Google Sheet or anything like that. You can also use HubSpot. But just make sure that you have an investor CRM and you keep track of your progress. And then on top of that, start attending events. You need to start increasing your network. So events, being part of the Ford Effect, anything like that you can do to kind of like increase your network is super important. Then for investor materials and pitch practice, make sure you have your teaser ready, a financial model, can be a simple financial model, and a data room. In your data room, you will have beta interviews, beta surveys, SEO data, any go-to-market strategy, anything like that that can kind of help them dig deeper into what kind of business founder you are and how you will run the business. And then practice your pitch. There are a lot of pitch practice options in every city in the United States. So for this, for example, it would be really good if you know one of the ecosystem builders in your city, and just see if you can practice it somewhere. On top of that, of course, you can practice with your friends, but make sure that you're practicing also with people that you don't know that well, so they will actually give you real hard feedback. Um, and then start conversations. So once you've received some of the warm intros, you have been meeting some investors at networking events and stuff like that, you can start the real conversations and you have everything ready to actually run a process. Cold personalized email can still work. Just make sure that you don't do a scattergun approach. So be super personalized on this. Like, have they recently wrote a blog post that you actually found really interesting and it's related to your company, then reach out to them. So it needs to be related to something. And then send regular investor updates. So of your 95% no's, when you get a no, ask if they're okay to stay in the loop. If they are, you're building a full list of investors that you're going to send quarterly updates to, at least quarterly. This is great for your current process or your current capital raise, but it also is great for your next one. Investors talk to investors all the time. So if you keep them in the loop and you keep top of mind, they will start talking about you. Then lastly, tools and resources. Prepare materials. I just wrote a couple down here. I think it's important that you know that you can use anything else as well that you already like. But at minimum, of course, for your pitch deck, you can use Canva or Figma or anything like that. Know that in the end, you will have to be able to turn it into a PDF, because investors use DocSend, and so you send your pitch deck with the DocSend link, and then you get some data on that. But on top of it, investors are always on the road, so it's important that they can just scroll through it on their phone. A Loom, if you don't know Loom yet, it's a great way to do a demo of your a product. So use that. Of course, Sheets and Forecaster for any financial models, and then Carta for any investment market data. Then how do you find investors? You can go on Crunchbase, PitchBook, LinkedIn, and the ACA for finding some of the angels. And then how you run your process, you can do HubSpot, Salesforce, Sheets, if that's how you want to do your investor CRM. And email will be the most important part because you will going back and forth with investors. So find the contact information wherever you can find it. And of course, a shameless plug, because that's why I talk about this topic all the time. We build Capway for you to make sure that you can do your capital raise more efficiently. One of the things that is very great about Capwave is that we help you match to the right investors. These are active investors, so kind of like that first 3 steps you don't have to do. And then on top of that, we tell you exactly who in your network is actually connected to these investors and can provide you an intro. So it just saves you a lot of time. You can take a look, you can get on our wait list, and we will launch a full product in January. Just one note, whatever tool you use, don't ever just send your pitch deck to anybody. You want to use some form of doc send or anything like that to make sure that whenever you update and something changes on your business, you can update it in DocSend, and then that link still goes to the most recent presentation. Don't send a PDF presentation just to an investor. Always share it in a link. And with that, you've got this. It's not easy, but if you prepare really well, you will get there. And if there's 2 things that you take away from this, simplicity sells and creates FOMO, and proof, so your data, is eventually what wins you the deal. And with that, I would love to open to questions.
Fantastic presentation. Thank you, Charlotte.
Of course.
I do see some questions in the chat, and I have one myself. But I'll start with, oh, somebody just put in 6 questions. But I guess I'll start with the last one that I see. Do you suggest that founders always have an executive summary with their pitch deck?
We don't, no, you don't have to. I would say have 3 bullet points ready in the email that you send to an investor, so they know exactly. And what you want to put in there is metrics. So either you are a serial founder, or you have, like, this is the credentials that you have, or you've been featured in this. On top of it, you can add, like, this is our current wait list, or this is how far we are, and this is what we expect to do. So put some metrics, put some, like, proof points of, like, this is why you should talk to me, and I'm an amazing investment. So not per se an executive summary, but definitely have your 3 bullet points ready. What's the whole purpose of them talking to you and opening your deck?
Amazing. My question was, what do you recommend? How often communicating? How often do you recommend you send out that investor update so that you're not going?
So while raising, of course, you always want to have something to say. So it depends a little bit on how your business is evolving. While raising, I would say at minimum every month. When you're in between rounds, so let's say between your pre-seed and seed, or between your seed and Series A, every quarter.
Fantastic.
You know what? There are so many questions in the chat now. They're all just like starting to pour in. Maybe I can pick out a few and hand them to you. You know what? I'm going to start at the top.
Okay.
First questions that came in. Okay, so there's a question here from Jennifer Fletcher, and she says, okay, so she's saying, with respect to avoiding VCs, groups who have invested with competitors, wouldn't they be a good place to start, especially if you're early stage, because they would immediately grasp your business model and understand the potential profitability because they've already invested in your competitor. So you'd know that you fit with their portfolio, and they would know that your projections might be right. So would they be incentivized, and can you pitch it that way, that this will increase their profitability?
Blank answer is no. And that is primarily because investors don't invest in competitors. If they are already, if they have that company in their portfolio currently, then no. If that company is exited and they don't have that company in their portfolio, then yes. So it really depends on the timing there. If that company is still in their portfolio and it's a competitor to your business and not an adjacent business, it's a real competitor, then they will just ask you for a lot of data and a lot of stuff that you're doing, and they're going to tell their portfolio company to do the same.
Okay. That's really a great answer. I had that question too. And then, okay, so now I'm getting to the list of the person with Isabel has a bunch of questions. So the first, she makes the point, lots of investors go for hockey stick growth and a quick exit, which is fine. But the reality is that very few companies can actually deliver. So how do investors see sustainable businesses that are not hockey sticks, but just the actual real numbers?
So investors usually get about 10 years to return a capital to their LPs. So if you don't think that you can grow significantly in the next 10 years, then the VC model does not fit for your business. That does not mean that there are no investors out there for your business. It's just not the VC model that fits there. So the type of investors that you're going to be looking at is maybe some corporate investors, so corporate VCs, because they might be interested in eventually buying you, or another one that's good is just some larger angels like family offices and stuff like that. Those could be good because they have a different profile. But the real VC bucket is not going to fit for your business. You can still grow your business, and there are a lot of other options out there as well to still get investment though.
Okay, that's great. And then how do investors see crowdfunding, like WeFunder efforts or grants that a company used to raise funds when, when they were building?
Non-dilutive grants are great because that's basically free money. So you can grow on free money, which is awesome. So definitely get those if you can, if it fits your business model and stuff, find out wherever they are. It does take a little bit of effort because you have to report back, and you often have to go through some sort of like program or something like that to make sure that the grant is spent on the right things, da, da, da. And then when it comes to, sorry, the other one was?
Crowdfunding.
Oh, crowdfunding. Um, Investors, especially VCs, are not a big fan of crowdfunding at all. Yeah, this is a tough one. Crowdfunding depends a little bit on the structure that is used. If it's an SPV, which means that there's only one entity on the cap table, it might be okay. If it's a lot of different investors, it just crowds your cap table, and investors will probably run away from them.
Mm.
So in that case, you have to clean. If you did it, it's totally fine. We just have to clean up your cap table. So you will have to start putting everybody in an SPV, and hopefully everybody's okay with that, but you need to clean it up.
Okay, it was super helpful. Now, what about stealing? When you're out there pitching, the common knowledge is don't ever ask for an NDA. So
Yeah.
should you be worried about that as founder?
No, just don't go after the investors that are actually invested in your competitors currently. Don't do that because what holds them back, right? They want their portfolio company to win and grow as big as possible. But there is a balance between building in public and pitching and getting more brand awareness, and then between really going after somebody that will definitely use your information. So it should still be fine. Everybody can still build things, and hopefully there's more to your business than that somebody can just do that within 3 months and actually win you over.
Okay. Okay, that's great. And then now this next question, sorry, I'm going through all 6 of them. So this is, many of us haven't raised funds before, or we don't have the option of warm intros. If we are going with, or sorry, if we're not going to go with cold emails, then what would you see as a bridge to cross this gap?
Yeah, going to events, meet investors. So it's gonna be super draining for your emotional battery, but you have to go. Like every week, go to a minimum 3 events every week, and do that for at least 3 months, and you will build your network.
Okay, that's great advice.
Yeah.
Okay, which would be the red flags? Okay, so this is kind of a general question. Red flags an investor looks for. There isn't more context than that, but I guess maybe what are like the top red flags an investor looks for?
So small market is a no-go. Like, and when I say small, if it's less than $500 million, it's just going to be hard. It's not going to be easy to raise from a VC. Again, we're talking VC perspective. Angels very different. Just show the ROI on what your business will bring in the next coming years, and then they will still be interested. So that's very different. But when we're talking VC, crowded cap tables, definite no-go. If you have like 100 investors on there, which are like individual investors. So when you think about your angel rounds, think either let's do an SPV, which is then just that one line item on your cap table, or make sure that you have a minimum check size. And that kind of like crowds out the rest of the smaller checks. Now, I'm a big proponent of actually having smaller angels on there because it's easier to convince everybody. And I think it's also great for just promoting angel investing in general, but use the SPV. So if they're okay with the SPV, that's great. And there are platforms out there that you can actually do that on. Like, I don't know if you, Kat and Bree, know Cheryl Cullen from Let's Pay Money.
That's our SPV is being run on the,
Okay. Yeah.
and we're partnering with them. So we
I
want to
love it.
use her Play Money SPVs to invest in our startups in our back room. So
I
yes,
love it. Yeah, no, so I'm a big fan of it. It's just like you do want to have an SPV over all these smaller checks on your cap table. So that's a red flag. And then if you have zero knowledge in the field that you're actually building your business in, and or zero background in it, that is not particularly a red flag immediately, but then you do need to show more traction. So you do need to show that you are able to execute and you're able to do it. So if you really want to make sure that you show your secret sauce. Like you need to have some sort of secret sauce to be building this business. And then, another really big red flag is and please don't quote me on this, but if you decided to go with a venture studio and they took 50% of your equity, that's going to be harder when you raise for later on.
right. And what, okay, so I think this is a great red flag for people to pay attention to. Does it have to be 50% or can it be, because there's, a ton of programs out there that take 2% or take 5%
That's fine.
or take, okay, you think smaller ones, but I've heard that if you don't also get money, like if you're just giving equity to a program, but they're not
Yeah, no.
investing in you, that's really bad.
Yeah, that's really bad.
Okay.
You never just give equity away. You get it for money, and usually they get a really favorable valuation on that deal. So for example,
Right.
for YC, right, like it's a very low valuation, but you get all the exposure with it. So
Right.
I'm a fan of accelerators or anything like that. If it is in return for money, of course, for an investment, and on top of it, you get a lot of knowledge and brand awareness and your demo day and all of that. If it's purely for like, if it's a venture studio and they say we build together with you, I'm not against venture studios, but just know that it will impact the rest of your funding journey, because VCs are not going to be super interested, because as soon as you dip below 50% on your own ownership, and especially if you're just raising a Series A, and given you're going to give up about 20% dilution every round on average, you're not going to be incentivized to grow this as a really big business.
Yep. That's
That's,
just great. Super helpful.
yeah.
Okay, now there's two quick questions just about CapWave. What's your pricing? And then what are some best tools for the investor CRM, which I'm guessing CapWave is an investor CRM. I don't know. I definitely had this question as well. Like we use HubSpot. Also, our platform is a CRM. So like sitting in my seat, do we already have an investor CRM? We just don't realize it. So I don't know. You can answer that.
Yeah. So it depends a little bit. You can do it on HubSpot. You can do it on your own CRM, whatever you have. I think the most important thing is that you are organized. That's number one. The reason why we have a CRM on our platform is because that's where all your investor matches live. and you can actually upload your own investor network that you already have as well. So you have it all in one place. And on top of that, Capwave right now is fully built for founders like yourself, but eventually it will be a marketplace where investors look on the back end. And one of the most important things is then why you would want to have it on Capwave is because we automate your investor updates, and investors will actually sign up for your updates like they sign up for a newsletter.
That's such a great idea. I mean, I did kind of know this. It's so great to hear it from you.
Yeah.
Okay, very interesting. So what about your pricing?
Pricing, if you sign up for the wait list right now, it will be 50% off at $49, I believe. Otherwise, it will be $99 a month, and there will be an annual option as well.
Great. Okay. Okay. Now, another question. There are founders who raise money on an idea. In what scenarios do you see that working? I love this question because background as a tech lawyer and have had a lot of, startup clients that have had a lot of success. Just they have an idea and they have $3 million and then they go out and they try and build it. Now, for most startups in the fourth effect, we happen to be underrepresented. That's not our journey, right? No one's giving you $3 million for your idea unless you are one type of person that knows one group of people. So I think this is a great question. So maybe, I'll let you.
This is only for a particular type person, indeed. It depends a little bit on your network. Who are your parents? Do your parents know influential people? Do you come from a really wealthy background? Did you go to an Ivy League school? Like all of those things actually really play into that. And it's just knowing the right people, being there at the right moment, getting introduced in a certain way, and having a revolutionary idea. It's usually not like for a very simple idea. But all that to say, I don't know if it's actually in your favor if you raise a round on an idea because you're going to go at a very low valuation. So I would actually advise against it. If you can bootstrap, get your valuation to a better position, and then raise capital because that's the only way you dilute yourself less.
Great insight. If you don't fit an investor's thesis, how do you ask them for additional warm intros?
Befriend them first. Don't just ask for intros. I think one of my pet peeves, for example, is actually when just random people reach out to me on LinkedIn and they say, hey, we are also not connected, but can you please intro me to this person? And I'm like, I'm sorry, but I don't even know you. So why would I do that? In the end, social capital is a real thing. So in order for me to give an intro to somebody, I need to know what you're building and need to kind of like stand behind it in some form of way. I'm not saying that I have to have invested in it or anything like that, but I need to know you in a way. So first build your relationship and then say, don't ask immediately for intros, but just say, hey, I'm looking at these different investors. When you look at this list, do you think it makes sense? Ask for advice. And then they say, yeah, doesn't this make sense? And then I say, hey, I saw actually that you're connected to them. Would you be willing to give us an intro? And that's the way to do it.
Okay, great. How best to position the teaser when you're sending that versus the full deck when investors always request to see your deck? So that's question number one, and then follow up. And if you apply for a grant, which one do you send, the teaser or the full deck?
The teaser as well. It depends a little bit on what the grant is for. So is the grant really related to economic development of the city? And because of that, they are really focusing on startups that are currently with big visions, but they're still currently building. For example, Capwave just won a grant in North Carolina because I live between New York City and North Carolina. And that was really great. So what I did there is kind of like just present how big the opportunity is of Capwave on its own. So send your teaser, then you will probably have to do a pitch and stuff like that. For investors, I think the most important thing is that you just know a grant is a little bit more like a different animal. People are usually a little bit more friendly. When it comes to investors, you need to be super competitive. So just make sure that your teaser is like super clear on how it's going to make them money. So what's the ROI on this? And make sure that you send it with a doc-send or anything else where you can share or get the insights, because it's super important that you're tracking it and that they're not just sending it to other people. Also, another thing is that I personally am not a big fan of investors downloading your deck because again, it becomes stale and stuff like that. So if you're sending a teaser, that will always be a link. If you're in conversations with them and you're sending your data room, you can make that downloadable because you're in further conversations, so they're actually serious.
That's really a great tip. Okay, can you walk us through how varying investment committee practices affect the raising process? That's question number one. And question number two, do investors give preference to companies with provisional patents? Okay, so I guess those are very different topics. But
Yeah. Investment committees, super important. Also know who you're talking to. So title of the investor that you're talking to can be quite important in like seeing how far your deal might go. For example, associates, if you talk to an associate, associates are great and it's a great way to get in, but they are not the decision makers. Principals have a little bit more power there. And then of course, like a general partner, or if you're talking to a partner, that's the best person to talk to, but usually that's not where you get in. So it will be maybe an associate. If you get to a principal and they are convinced, then you have a good, I guess, like a good process going. When it comes to an investment committee, just ask. So when you have the conversation at the end, of course, by the way, when you do your pitch, 50% of the time is your pitch, 50% is questions and answers. And of that 50% time question and answers, that's actually where you also ask questions. So you ask a question, what does your process look like? How big is your investment committee? What are some piece of information that I can provide to you to get you through that IC? Those are all important questions to ask. So you basically give all the information you have about your startup as like an investment memo almost to the VC so they can run it through the IC in a successful way.
so interesting. Okay, and then the next one, do investors give preference to companies with provisional patents, like if it's applicable?
Yeah, they like it. Usually it's mostly important actually later on. And it's a little bit of a tick of the box action, honestly. But yeah, it can be good if it's defensible.
Okay. Now, there's a question about safes. Okay, Jessica Greenwald, let's see, what if we're using safes since they don't typically end up on the cap table? Okay, Jessica, I don't know, I'm not sure what you're responding to. Do you want to do you still have a question that hasn't been answered?
Yeah, this I just posted that because you guys were talking about how you wanted to minimize the number of people on the cap table or number of parties on the cap table. So when you had a lot of parties, you wanted to try to combine them into one. And I was curious how that works with safes since it's effectively a promise for equity later. How do later investors feel about that? Like, how do you present that to them?
Yeah, safes are good. In the end, it depends on what the valuation is on that safe. And or like the people that have done a safe are still an investor in your company, so they will still be on your cap table.
Okay, so even though it's not technically ownership of equity, that is you put them into the list and show them as holders, right?
They are equity holders, you just don't know at what valuation yet.
Okay. Okay,
Yeah,
gotcha.
like the SEC regulations apply to anyone who is coming in under a safe. So like you
Okay.
still have, yeah, like all of that, kind of legal like hoops you have to jump through apply in that situation.
Exactly. Yeah.
Okay, gotcha. Thank you so much.
Okay, another valuation question that's kind of related to Jessica's question and like, with safes, I think this is, I've heard this a lot. So what are the risks of raising at a super high valuation and then setting yourself up for a future down round? Like, so I guess I'll just leave it at that.
Yeah, there are risks to that. You need to be super. So in the end, at the moment, at the current market, you need to show traction to back up your valuation. So what that means is that if you are super convinced that you're going to get to a certain amount of traction and your multiple in that particular industry is, let's say, 10x still or 15x still, and you think, okay, my next round, I can get to my next round and my next milestone with that particular revenue number, and that will mean that it will be not a down round, at least it will be an up round, then it's totally fine. I think the most important thing that you have to keep in mind is like, try to bootstrap until a point where you're happy with the valuation and with your dilution that you need to get to. Then if at that point you're like, okay, well, so I want to raise at $7 million, which is usually like kind of average at $7 million, then you can go to, okay, then where do I need to get to? And can I get to that amount of revenue to next time I can raise at 12 million or 50 million or 20 million, whatever it might be. So just think super strategically about it and be honest to yourself if you think you can get to that traction, yes or no.
Okay. And then what about if you find yourself in a situation where, it was a great market, you started off with this valuation that you thought made sense based on comparables, you took in some checks through a safe at that valuation, but then the tables have turned, the market's bad, you're now a year later and you're like, I don't want to have to fundraise at this valuation anymore because it's going to be much harder. I would rather, like cut it in half. Like
Yeah.
what do you like, how bad is that as a founder? What are the red flags? Like, what are the issues?
I would say like, think about it like this, and this is all strategy, right? So you could do the following. You can do a bridge round where you can say, okay, well, I can actually with just a minimum amount of money and I can raise it at a lower valuation. I can get to at least the valuation that I initially took checks at. That's one way to do it. Another way to do it is just go back to your investors that you raised at a higher valuation at and discuss with them what they are okay with, because it is important that you keep them in the loop, because if you undercut them without them knowing, that's a very bad look and that will haunt you for the rest of your startup journey.
Very good advice. Okay. How would seed, pre-seed, startup, tranche round? Oh, wait, sorry. This Vibhu, I'm not sure if I'm getting your question right. Do you just want to ask it yourself?
Yeah, absolutely. Happy to ask the question. Thanks for taking it. So I'm kind of very early stage pre-seed seed startup in AI, lead AI strategy for big tech, etc. What I'm thinking in terms of fundraising is two options. One is probably 6 million round at 50, 60 plus valuation, which is high in some context. But in other area, I'm also thinking I have option to raise 3 million at maybe 20, 30 smaller valuation, get the product started, get the company started and build something, right? Now I'm going to have a double the dilution if I have two different rounds. But the thought process is, if it's going to take more time to close a 6 million round at a high valuation, I would rather start with 3 and can I tranche it across time in some way to still minimize the dilution, get company started, get building, leverage, for example, holiday TR time, etc. And approach it in a different way.
How much do you need?
We actually need 6+, but we can start with 3 because it's overall a platform play. So we can do part of the stuff, but ideally I would need larger. But having said that, there's tons of investor interest, everybody chasing me in few weeks, etc. Downstream investors. But for pre-seed, seed kind of a people, I have noticed that 6 is a larger ask for them because they're used to writing smaller checks, So
Yeah, 6 is a lot, honestly. So I think in the end, you have to think about it as like, what money do I need for the next 18 to 24 months to get to some sort of traction? So if you can do that with 3, you 100% should go for 3. And in the current market conditions, I would not try to raise more than you need. It just doesn't make sense.
So I can do away with 3, but it will just be a part of the product, like fraction of the stack, and I can do with 6 with a larger.
Market with $3 million.
I can bring the product to the market, and I will use.
Okay, well that's the answer basically. If you can bring it to market for 3, then go for 3 initially, and then if you show traction early on, and you can already do that with the 3, you will just have a better chance of less dilution later on.
That's true, but this is an AI infra play. So showing a traction, like unlike other areas like enterprise, B2B or consumer, etc., is not going to be easy. The product building itself will take like several 8, 9, 10 months for the stack, right? So I may not be able to have some milestones in 3 months or 6 months. So the question is, can I keep like an open-ended round and maybe tranche it, saying this is a 6 million round I'm going to raise. A
Yeah.
plus B plus C. I'm going to do A plus B or A now. So this is the first 3 million round. And can I keep it like after a few months or whatever, right? So to avoid that double
Okay,
dilution.
and you know what, Vibhu, I have to, since we're 2 minutes over, so I have to just be sensitive to everybody else. People are starting to drop, but I know a lot of people have hard stops. So we do need to wrap this up, but I'm sure you can, you know, maybe continue to get an answer to your question with Charlotte after people leave and we end this. But for everyone that came today, thank you so much for attending. We hope to see you in the fourth effect. And obviously, Charlotte, thank you. This was just very, very helpful, useful information. So thank you for sharing it.
I appreciate it. Thanks so much.